Okay, deferred revenue. Deferred revenue is, for the most part, uh, fairly straightforward. Deferred revenue are instances when, to me, it just helps me to like think of these things in terms of plain English. So deferred revenue are instances when the customer pays in advance. Pays in advance. That's the worst looking in I think I've ever seen. Pays in advance. And then we perform service later. Happens all the time. Man, my writing is so sloppy. But this happens all the time in accounting or in legal services. Customers will call up and ask for a bunch of work, and they don't really realize how expensive it is. And so, if it's a new customer or a new client, we've typically in the past have asked that they pay in advance, like they pay a retainer. Deferred revenue is just like a retainer. So let's say a client calls me up and says, "Hey, we would like you to work on our case for a good 6-7 months." And so they call us up again on maybe say, let's say they call us up on November 1st, and they say they have this huge project and they want to get started, and it's probably going to go to trial in the following month, sorry, the following year, sometime in late April. And so, since we've never worked for this client anymore, we say, "Hey, listen, before we get started, why don't you prepay $100,000?" Right? So the client agrees and pays us $100,000. Now, remember, it isn't revenue because we haven't done anything yet. And so we can't treat it as revenue. Instead, what it is we call it unearned revenue. And that is a liability because we're now obligated. If we take this client's money, we're now obligated to either do work for the client or give the money back. So on November 1st, when the client pays us in advance, the journal entry is going to be cash. Cash is an asset, $100,000. And then unearned revenue is the credit. And that would also be $100,000. And again, unearned revenue is a liability. And so we would credit unearned revenue. Then on December 31st, we have this account. I'm just going to abbreviate unearned revenue. It's a liability for $100,000. And what we would do is it would finally make its way all the way down to the trial balance. And the trial balance would have that credit balance of $100,000. And we would be looking at the trial balance and we would say, "Hey, have we earned any revenue? Like, have we actually started working on this case?" And so we would go through our billing records and we would total up the value of all the work that we've already performed. And if it's the case that, they prepaid for $100,000, they paid on November 1st and we're now on 12/31. We're not going to issue the report until out here some point the next year. But what we want to do is we want to figure out, how much have I already earned? How much have I worked on this period? Because remember, in order for it to be revenue, it is going to be instances when we deliver the service. So we would total up again all the books and records. And I'm just going to make something up. We could say, "Hey, you know what? We've actually worked on this case for a total of $30,000. So the journal entry would be, I'm first going to debit unearned revenue. That is a liability that I am lowering. And so I would debit unearned revenue. And then I would credit revenue by the same amount, 30,000. So we just moved that 30,000 from the obligation to the revenue. That really is deferred revenue.